Starting or growing a business requires capital. While some owners self-fund initially, most need access to additional sources of money at some point. This guide will cover the main options available for business financing and tips for securing the funds your company needs to thrive. Determine your funding needs. The first step is creating accurate financial projections that estimate how much money you need, what it will be used for, and when you need it by. Break expenses down into categories like equipment, inventory, payroll, marketing, and working capital. Include profit and loss projections. Banks and investors will want to see detailed plans for using and repaying funds. Consider self-funding options. Begin by exploring resources within your personal network that don't require formal applications or qualifications. Personal savings. Using your own money removes the repayment obligations of financing. However, funds are limited. Friends and family. Often willing to invest smaller amounts through informal agreements without interest expected. Keep business and personal separate. Crowdfunding. Websites allow fundraising campaigns pitching business ideas to individuals. Carries fewer strings than formal investors. Credit cards. Can be used short-term for startup expenses, but interest rates are higher than traditional loans. Manage spending carefully. Business loans. Loans are a standard financing path and make up the majority of small business capital. Lenders differ by size, rates, terms, and requirements. Shop around to find the best option. Small Business Administration, SBA, loans. Backed by federal government agencies to encourage lending to small firms through participating banks, lenders. Common types are 7. Loans for general purposes and 504 loans for commercial real estate acquisition or improvements. SBA guarantees help qualifying businesses receive more favorable terms on loan amounts between $50,000 $5 million and longer payback periods of up to 25 years. Conventional bank loans. Local, regional banks may provide business term loans or lines of credit without needing SBA backing. Require solid business and credit histories, collateral, and strong financial projections. Approval is competitive. Loans are ideal for creditworthy companies needing funds for expansion or operational expenses. Amounts typically $100,000 $500,000. Factoring. A method of getting paid immediately by selling customer invoices or accounts receivable to a third party at a small discount rate. Used by businesses needing cash flow rather than funding for specific expenses. Has ongoing costs. Merchant cash advances. Companies receive daily lump sums from lenders in exchange for a fixed percentage of future credit, debit card sales until fully repaid. Provide upfront capital funding for expenses but take significant percentages of daily revenue over 12-36 months in repayment. Carry high costs. Only consider as a last resort due to unfavorable terms. Alternative lenders. For new businesses or those declined elsewhere, consider online or specialty lenders evaluating less traditional applications. Online lenders offer fast decisions through digital applications for amounts under $150,000, sometimes with same-day funding but higher interest rates than a traditional bank. Community Development Financial Institutions, CDFs, offer low-cost lending to underserved areas or industries using non-traditional credit evaluations. Equipment, commercial financing institutions provide loans secured against assets to purchase machinery, vehicles, or new technology. Equity financing. Equity financing involves selling partial ownership stakes in exchange for capital investments from angel investors or venture capital firms. This option is best for businesses seeking larger amounts and when loans aren't sufficient. Angel investors. High net worth individuals funding projects very early, often before other options are available. Angels seek 10-20% ownership shares. Venture capital. Firms providing between $1 million to $10+ million in exchange for equity percentages closer to 20-30%. Target companies with high growth potential and demonstrated traction. Extremely selective process. Equity crowdfunding. Federal rules allow unaccredited individuals invest in startups and small businesses through online portals in exchange for ownership stakes as small as $100 in campaigns regulated like securities offerings. Securities. Selling company ownership represented by stock, other instruments to multiple investors subject to regulatory oversight depending on quantum of shares, capital raised. Requires legal assistance. Preparing your financing request. Thoroughly research options and build a compelling package proving your business merits funding. Key components include Professional business plan with financial models, projections. Personal and company credit reports to identify any issues. Tax returns, financial statements and collateral assets, property, inventory. Strong management team bios demonstrating expertise and experience. Track record of sales or proof of concept for new ventures. Well-articulated description for use of investment proceeds and exit, repayment strategies. Realistic operational budget and timeline for achieving your financial projections. Secure references and approvals. Financing takes time, so start preparatory steps early. Gather letters of reference from customers, suppliers, advisors or former employers. Many programs also require local government approvals or endorsements. Do not wait until the last minute to securing prerequisites. Understand funding terms. Be familiar with standard loan agreement clauses and investor rights to negotiate in your best interests. Do not be rushed into unfavorable positions. Seek professional legal counsel if necessary to review paperwork thoroughly before signing on any financing. After securing capital, keep investors, bankers updated with periodic financial statements demonstrating progress towards plans. Maintaining strong relationships ensures continued access to working capital support for business growth over time. Overall, adequate planning makes fundraising significantly smoother and more impactful.